If you plan on retiring in 2026, there are many things you need to be planning for now.
Here's what you need to do in the next year.
Hi everyone, my name is Alex Sunners, this is Jackson Courtney, and we're going to be talking about all of the things you should be doing now in 2025 if you want to retire in 2026. So there's a lot of different things that you really should be thinking about now, and I think a lot of times we focus too much on the, oh, you're 5 years from retirement, oh, you're a couple years from retirement. But what about you're retiring in 3 months, 6 months? What should you be doing now? And I think you just need to start asking yourself some questions, make sure that you are ready for retirement. You know, what does retirement look like for you? What does that emotionally look like? What does that physically look like? Are you financially ready to retire? I think that's a big one. I think most people do understand that, but it's just good to check in with yourself and say, okay, am I really financially ready to retire? Also, what is your healthcare going to look like? That's going to be different from the majority of your life. In most cases, most people get their health coverage through their employer, and now you're leaving that employer. So you gotta think about, what does your healthcare look like? How are your taxes going to change? Start planning out, oh, I'm not gonna have withholdings from a paycheck anymore. I'm now drawing from this retirement account and I'm getting this Social Security and pension. Your tax situation is gonna look a lot different, and you should ask yourself, what's my plan for my taxes? And lastly, you should be thinking, is my investment allocation appropriate? Going through all your life, it's going to be a majority in stocks and equities. And as you get closer to retirement, as you get further into retirement, that's going to have to change as well.
That's right, Alec. And you know, the biggest thing, like you said, as you start planning for retirement a couple years out, you really need to hone in on how much you're going to spend.
Yeah.
You know, the number when we run retirement projections, it's all based solely, not solely, but you know, the focus is that it should be on how much you're going to spend every year and how fast that's going to grow. Because you know, as inflation grows, you know, so will the amount that you spend as well. So the easiest way you can do this is simply, you know, multiply your net pay from your paycheck, and you know, once you've netted out all your health coverage, all your retirement savings and things like that, then you say, okay, my net pay, you know, times, you know, 26 pays, if you're getting paid every other week, then that's kind of your annual spending. But the best way to do it is to actually track your expenses. And, you know, we use different apps or even just a simple budget to track spending. And that really lets us zero in on what that number is going to be. Yeah.
And we say the quote unquote easy way is to look at your net pay. But I really, really hate when I'm going through a budget with someone and they just say, oh, my paycheck was $2,000 every 2 weeks. Let's just multiply that by 26. And yes, that gives you a ballpark number, but a lot of times people aren't realizing that some month they're taking some from their savings, or on the opposite end, they are saving a lot of that paycheck, and that number really isn't the most accurate.
Right.
So I do think it's important that you are tracking your expenses leading up to retirement.
Right.
And once you get that number, your annual spending number, now it's time to understand, how are you going to get that number once you're in retirement?
That's right. And, you know, one of the things you said there is your expenses, kind of a balancing act, if you will, is your expenses with the income coming in. Well, a lot of times what we find is that the expenses outweigh the income coming in. So, you know, we've got an example up here where, you know, your annual spending number, you did the calculation, you came up with $150,000 a year. And you have Social Security of $40,000, you have a pension of $30,000. So right there, you already know that the withdrawal need from your portfolio every year will be $80,000 approximately. Now, here's where the portfolio starts to come into play, right? So we've got a couple different allocations set up here. You'll see in the middle of each scenario, you've got a dollar amount, but then also a percentage of, you know, that's kind of our long-term rates of return. You know, these are kind of loosely how we have them in our projections. But what you have to think about with your allocation is that balancing act, right? So if we need $80,000 and we have that deficit, well, we're going to need it from the portfolio. So if we have a conservative portfolio in scenario one here, where, you know, we're assuming kind of a 3% rate of return long term. That's very conservative, but that 3% is only going to get you about $60,000.
Yep.
So if you're a client that needs $80,000 every year, then maybe you consider moving to something like the moderate portfolio that is maybe invested a little bit more aggressively, but still has that foundation of fixed income and things that will actually potentially meet that 4%, that $80,000 need. Now, the flip of that scenario is also true. So let's say you're preparing for retirement in the next year and you have an aggressive portfolio where it's all stocks, and that 5% rate of return is great. The higher rate of return is, obviously clients want to see that, right?
Yeah.
But at the same time, you might be taking on a little bit more risk than you need. So, again, if you only need $80,000 as opposed to that $100,000 that we're showing there, then maybe you consider taking some risk off the table and moving down towards that moderate portfolio.
Yeah. And I think it's important to also understand is that, this 3, 4, 5% rate of return, it's a hypothetical. And even if we can go ahead in the future and look back 30 years and say, okay, here was our average return, that doesn't mean that return happened each and every year.
Right.
So it's important that when you're doing your financial projection for retirement is you do a stress test for your retirement plan, because your returns are going to vary year by year. So if in that hypothetical you need 4%, $80,000 per year, you're not going to get 4% every year. Some years you're going to get 10, some years you're going to lose 10. Just because it's an average of that 4% doesn't mean that you're going to get that every year. So by stress testing your plan, you can then go ahead and look and say, okay, what happens if that rate of return we projected was too high? Mm-hmm. What if we do have lower rates of return in the future than we've had? And you should stress test that. And you should look at your financial goals as, okay, I need $80,000, but how much of that do I need? How much of that do I want? So you can say, okay, I need food, I need to pay my bills, the mortgage, a car payment, et cetera, et cetera. But do you need the lavish vacation? Do you need the trip on the sailboat? You should split your needs and wants so that when you do these stress tests, you can say, I've got just an example up here. All right, if returns are dropping 1% off of that average return in perpetuity, this client says, okay, my needs, I still have a 78% chance of success. When I include those wants in that, well, now I'm dropping down to 62. So maybe in your head you can say, okay, if returns are lower than projected, I'm still going to be okay to put food on the table and pay my mortgage and pay my car off.
Yeah, and it's kind of like you said, having those different buckets where, again, if you have a tough market year, then maybe that lavish, luxury vacation bucket, it doesn't get filled that year. But,
yeah.
Still having the needs being filled is obviously the most important there.
Yeah.
So let's talk about how we can maximize our contributions, right? And so, up here we've got kind of an order of operations that we like to think about. First of all, you have a family, you might have kids, you might have a spouse where, people are going to the doctor, you have your health coverage. But what we really like to look for clients are if they have access to a high deductible health plan. The reason for that is because once you use a high deductible health plan, you then have access to what's called an HSA, a health savings account. This health savings account is really, it's one of the greatest tools that the IRS has given us and our clients. The ability for a family to put away over $9,500 a year, and that's tax deductible on the way in. It's tax-free growth if you invest it, and then it's also tax-free on withdrawal if you use it for eligible medical expenses.
That's a triple tax benefit that you won't get in many other accounts.
And if you're looking at me and you're saying, Jackson, well, you know what? I'm not going to have that many health expenses down the road. I'm a healthy person. Well, guess what? You can use your HSA for things like Medicare premiums, even down the road, which, is now, depending on your tax bracket, is, almost $200 a month per spouse. Yeah. So, I can guarantee you absolutely will have medical expenses in the future that this will be beneficial for. So, first is that HSA. A lot of employers will even contribute some to your HSA for you. And that brings me kind of to my next point in the 401k. Here we've got the over 50 contribution limits. So for a 401k, it's $31,000 in 2025. But what's also important about doing the 401k ahead of the IRAs is that a lot of times your employer will contribute to your 401k and match your contributions. So you want to make sure you're getting all of that match, that free money, if you will, as much as you can.
Yeah.
And then excess can go down into the IRA and Roth.
Yeah, and I think it's also important that a lot of times people will say, well, I'll do my 401k up to my match and then I'll contribute to my IRA or Roth IRA. And a lot of times that can make sense, except when you say, I'm retiring in 2026. With the 401k, you can only contribute through your paycheck. With the IRA, you have until April 15th of the following year to make your previous year contribution. You can't do that with the 401k.
Right.
So you want to make sure you max out that 401k first so that you can do that within that calendar year of 2025 while you still have that paycheck.
Yep. And then just one last point here on contributions is we've kind of talked about having the HSA for your health expenses, having the 401k and the Roth, or I'm sorry, the traditional pre-tax 401k and the Roth 401k or IRA, having those two buckets, but then also having a third bucket, the after-tax brokerage accounts.
Yeah.
It creates, having those three buckets just really creates a lot of flexibility in retirement that we're going to talk about in a little bit.
Yeah. So one thing that we would also recommend everyone that's planning on retiring in the next year is to understand what sequence of return risk is. Because I think a lot of people don't know what this is. And
it sounds complicated.
It has a huge impact if you're on the wrong end of this.
Yes.
So essentially what sequence of return risk is it's really dealing with the timing of investment returns, especially when you start withdrawing from your portfolio, can have a long-lasting impact on the portfolio. So for example, if you have lower than expected returns or negative returns when you first retire and you start taking withdrawals, you're sort of locking in those losses while you're taking withdrawals out, and that portfolio won't recover from those losses, as well as a portfolio that sort of does it on a flip side. So let's say you have better returns when you first retire and worse returns at the end. Even if you have the same average return, the portfolio that has losses in the beginning is going to do worse than the portfolio that has losses at the end.
Yeah, exactly. I mean, think about a client who, it's the end of 2021, they retire, their income goes away from their pay, and all of a sudden they have the downfall of 2022 where you lose 15 or 20%.
Yep.
Then that becomes a much more difficult retirement scenario, at least for the first couple of years, than a client that say, retires at the end of 2023 and then 2024 market returns are great.
Yeah.
Right. So big difference there. But let's talk about some ways that we can help avoid sequence of return risk, or at the minimum, at least mitigate that risk by some stretch. So, number one is an asset allocation shift. So if you're heading into retirement in an all stock portfolio, then, you're set up to, basically take on all the volatility that we've seen over the last few years. I mean, we just mentioned it, 2022, you almost lose 20% in US stocks. And if you come in and you're 100% in stocks, then you're gonna take on all that volatility. So something you might do, you might go back to a moderate portfolio where maybe it's a growth in income, like we call it, where it's 25% non-stock, it's alternatives and bonds, or maybe it's even conservative where it's 50-50. So you have that kind of buffer, that partial cash buffer. It's bonds, maybe a little bit of money market, and some alternatives to kind of act as a buffer if you do get a 2022 type scenario. The other thing is having a flexible withdrawal strategy. So, if a client is retiring and they need income, typically the last place that we want to withdraw assets from are the stocks. Yeah. Right? Because if we withdraw from stocks and while they're going down, then just like you said, they have a much harder time recovering. Yeah. Whereas if you instead withdraw from bonds, then the stocks remain relatively untouched, and then you help to see that recovery a little bit more quick. And that's kind of playing on also this diversification. You want to be diversified in different markets, U.S. stock markets, international stock markets, short-term bonds, maybe some high-yield bonds or investment-grade bonds where they're yielding a little bit higher of a rate. Some alternatives, private credit, private real assets or infrastructure, or merger arbitrage, anything like that can help diversify the portfolio, buffer it from the really, really bad down years, and leave the stocks untouched while you're beginning your retirement.
Yeah.
The last thing that we like to think about in avoiding sequence of return risk is having different buckets, using this bucket strategy where you kind of have your short-term immediate needs, you have your midterm, and then you have your long-term, right? If we think about it, the long-term assets that we want are really stocks. We want to have stocks to outpace inflation long-term, but we want to have on the short-term side, we want to have things like a little bit of money market or short duration bonds.
Yep. Yeah, I think just understanding how to avoid sequence of return risk is important. It's not going to apply to everyone.
Right.
If you retired in 2024, it really didn't have a big impact on you because you did see good market returns. But we can never predict what the market's going to do next year or the following year. So it is good just to have those ideas of what can I do to mitigate that risk. So moving on to our next question you really should be asking yourself is, what is healthcare going to look like? So when you're working, you're likely going to be covered by your employer's health insurance. Once you retire, now what do you do? And the quote-unquote easy answer is if you're 65 or older, you can sign up for Medicare. As long as you're over 65, you can sign up for Medicare. If you're past 65 and you're still working and you go to sign up for Medicare, there's just a couple other steps that you have to take so that you don't get penalized for signing up late. But that will all be covered by going to your employer's HR and asking for a couple of things from them so that you can submit when you sign up for Medicare. The question is, what happens if you retire before 65? What are you going to do for healthcare then? And you can use a combination of things. If you are turning 65 in 8 months, you could use COBRA coverage from your health employer plan. But if you are 60 and you're retiring, how do you fill that gap until you're 65 for Medicare? And the answer is likely going to be the ACA exchange. You can go on the exchange for healthcare, and depending on what your income is, you could pay either very little for your premiums, or you might pay a little bit more if your income is higher. But there are ways that you can sort of control your income so that you get government subsidies for that health insurance. So if you're thinking about retiring, you're 60 and you say, okay, I need health insurance, how do I get income in retirement without producing income that's going to raise my insurance premiums? And if you have after-tax brokerage accounts, you can draw money from there. If you have cash savings accounts, you draw money from there. When you take money out of those accounts, you're not adding any ordinary income to your tax return. Whereas if you just say, oh, I'm retiring, it's time to tap into that 401k, tap into my IRA, anything you take out of those accounts is going to be taxable income. So it's just important to keep in mind, okay, I'm going on the ACA exchange, is there a way for me to control my income? And if there's not, well, the answer is you still go on the ACA exchange, you just don't get that government subsidy to pay for it as much.
Right. And something I think that's really important that Alec mentioned here is that the ACA is an income test. It's not an asset test. So, we've on occasion had clients who, you'd think from an asset level, wouldn't qualify for some sort of government subsidy, but that's not true because, like you said, it's an income test. So it's up to us to have a conversation with the client and say, okay, hey, how are you going to pay for medical insurance? Well, here's some solutions that we can potentially use for you.
Yeah.
So kind of like Alex said, one of the things that, you'll want to keep low is your taxable income. Well, let's create a plan for taxes then. And just like we mentioned earlier, we want to kind of have access to three main buckets of different taxability. We want to have taxable brokerage accounts where it's after-tax money. But the gains are taxable at long-term capital gains rates, not your ordinary income tax rates. We want to have traditional IRA buckets, for things down the road like QCDs if you're charitably inclined, where everything's pre-tax but on the way in, but then taxable at your ordinary income bracket on the way out. And then we want to have Roth, and Roth really is kind of the the saving grace here, where everything that comes out of it is tax-free if you meet all the rules. So we want to create a plan where we can use all three of these strategies. As Alex said, if you have a situation where you need health coverage and you want to keep your income tax low, then you use things like your brokerage account and your Roth IRA when making withdrawals. If that's not a worry, then maybe use your traditional IRA, or if you're charitably inclined, use your traditional IRA for things like qualified charitable distributions that come out tax-free. So that's how we kind of start with creating a plan for taxes, all while keeping things in mind, like all the income you're going to have, regardless, like Social Security, pension, interest and dividends.
Yeah, and that tax plan that you have is really going to change very much depending on when you retire. So let's put this example up here. Let's say you retire at age 62. So between 62 and 65, you're not going to have any Social Security income. You're not going to have any required withdrawals from your IRA.
Right.
And you're not going to have to worry about paying any excess Medicare Part B premiums based on your income. So those 3 years would be a great opportunity to look at Roth conversions. And a Roth conversion is where you take pre-tax money, take it out of the IRA, convert it into your Roth, and pay the taxes on it. The advantage of that is then that money then grows tax-free. And you have to do this strategically. You can't just say, oh, I'm 62, let me convert a bunch of money to Roth. You have to make sure you do a tax analysis to see, okay, what percent am I going to pay in taxes on this money? What can I expect to pay in the future? But for a lot of people, that time frame from when you retire to before you start taking your Social Security, or before you have to worry about excess Medicare Part B premium surcharge, is a great time to do those Roth conversions. But once you reach 65, now you got to keep in mind, if I create additional income, I might be paying more for my Medicare. And then let's say you start collecting Social Security at your full retirement age of 67, maybe your spouse waits until 70. Now you're having a lot of extra income come in that you're going to want to make sure that in the year that you collect your Social Security, just do a tax analysis and say, okay, how much am I going to owe this year because of this additional income? You can still look at Roth conversions depending on what your income level is, but with Social Security, you have to be very careful you're not bringing in too much additional income and taxing your Social Security more than what it could have been if you didn't create that additional income. Then you start collecting Social Security. A couple of years later, you start your required minimum withdrawals at 73 or 75 if you were born in 1960 or later. So that's when you have to take money out of any pre-tax IRA or 401k if you're retired, pay the taxes on it. A lot of people then use that money for their retirement income, but for some people, they don't need the income, and they can then reinvest it back into a brokerage account. You do have to take the money out of the IRA though. We've had people come to us and say, well, I don't need the money. I'm just gonna keep it in there. And unfortunately, that's not the case. That money does have to come out. You will have to pay taxes on it. And from there, you get to decide what you want to do with the money, but you do have to take the money out.
Right. And Alec, I love the timeline that you just gave. So one thing that we like to kind of practice, if you will, is a test run in retirement.
Yeah.
So, you're not retired yet. You're like the example that you just gave. You're 62, you're considering retirement. Let's talk about how, people out there can test it or practice for retirement. We like to think about trying to live off your projected retirement budget while you're still working.
Yeah.
So, instead of thinking, okay, well, I'm at the end of my career, I'm making the most amount of money I've ever made in my career, and I can spend like that's true. We want you to instead say, okay, well, what's my first year of retirement going to look like? What happens if I spend like that for a month based on that budget, or even something like a week? Just to give a test run on this, to see what your life is like, what your financial life is like, while spending on your retirement budget. The next thing that we like to do is test your withdrawal strategy without actually withdrawing money. So, you get your taxes at the end of the year. Again, think about if you had to withdraw money, what kind of taxability would it incur? Did it come from your Roth IRA and was tax-free? Did it have to come from your traditional IRA and incur ordinary income tax? Yeah. Did it come from your brokerage account where, you had to pay higher long-term capital gains rates on it? Practicing to see, okay, if I mix and match a couple of these, then my tax is X versus if I don't mix and match a couple of these, my tax is Y.
Yep.
Practicing that. And then lastly is kind of the more emotional part of the test run retirement. Take a vacation, but without going anywhere. And you're going to say, Jackson, that's ridiculous. I want to go somewhere for vacation. I get it. But if you do this, you take a week off of work or something like that, think about the things that you would be actually doing in retirement. Do you want to go golf? Do you want to go on a boat? Do you want to learn how to cook or something like that? I don't know. But if you take a vacation without going anywhere and you realize, okay, I could really see myself in retirement. I have things I could do, figuring out what you would retire to versus, what you're retiring from.
Yeah. I think that test run of retirement might be the most important thing. And if I were going to retire next year, which I'm not, I would definitely do this test run just to make sure that, okay, everything that I have planned for, everything is set up and will work properly. You'd be surprised how many people retire and then end up going back to work because they weren't emotionally ready to retire. They didn't have anything to retire to, so they just went back to work until they were ready. So I think that's very important. I'm glad that we were able to cover that.
Yeah. So hopefully you take all these steps and you work towards retiring in 2026. And if not, then we hope to go through these steps with you at a later date.
I think the most important thing that we didn't talk about is that if you plan on retiring in the next year, you should talk to us.
That's right.
To review your plan, review anything that's going on in your life currently, so that you can make sure that you are on the right track to be able to retire in the next year. So if anyone has any questions, you're more than welcome to reach out to myself, Jackson, or anyone at our office. If you're thinking about talking to someone, you don't have a current advisor, or you want to talk to us, you can schedule a free intro call with us either by going to our website or scanning that QR code there on your screen there. Thank you for tuning in, everyone. I hope you tune into the next one, and we'll see you next time.
Thanks, everyone.